Hello, everyone. I must apologize for being late. I was having some technical difficulties. So, yes, can you hear me? Let me know if you can hear me and if you hear me well. I am waiting for our host. There we go. Excellent. Hi, Shalini. Okay, great. You can hear me. I'm so happy. I was having a little bit of technical difficulties, so sorry. Now we're good. Oh my goodness. So people are starting to come on. How's your cold day going?
Oh my God, I had to walk outside for a few minutes to get to my BNI meeting, and I'm so ready to move to somewhere tropical.
This is when they sell a lot of vacations.
Oh yeah, there's a travel agent in our group, and she's like, we've been getting calls nonstop, which is a great problem to have. But you know, I'm spoiled. I park in my driveway or outside my office. Like, I'm not used to being outside. When I work downtown, yeah, you know, I had like 3 different scarves going on, and it was completely covered. But now I'm spoiled.
I hate it. Even though I do door to door, I just hate it. It gets me so angry.
But every day is one day closer to spring. That's what I keep telling myself.
Okay. Can't wait for it to get closer. How's the weather in everybody else's neck of the woods? Where's everyone else from? Because if it's anything like, where is it, Manitoba? That's like getting slammed with like minus 55 degrees. Oh, there you go. Manitoba. How's it going there, mommy? How is Manitoba, mommy? How is it?
I can't even imagine minus 50.
Oh my.
Wearing my scarf, my jacket, yeah. Probably sleeping in your scarf and sleeping in your jacket at that point.
I mean, I was just telling someone today that minus 10 and minus 50 is the same thing to me. It's just the same, okay? It's cold. It's wrong.
Although, one of our friends moved out to Saskatchewan and was saying that their cold, because they're not near the water, is not quite as in your bones cold. So he actually prefers, it's colder there, but he feels warmer. So we're like, you're weird, but sure.
It takes some convincing. Not I. So I'm sure everyone doesn't really want to hear me. I've been getting a lot of.
I don't think you want to hear me either, but
they're here for you. I've been getting a lot of questions from people going, oh my gosh, I registered and I might not be able to log until later. Is it going to be recorded? Is it going to be recorded? Up until probably like 10 minutes ago. Like, yes, guys. Yes. So I'm very happy that you are Miss Popular. And I was not lying when it was backed by popular demand, because she is definitely amazing. So while I kind of ramble a little bit, I'm going to try to share this on Facebook so that if there are any questions from there, I can try to field those at the same time. So if anyone is brand new to the webinar and you're going, who's this chick talking? Didn't even introduce herself. How rude. Well, I apologize. I do have manners. They just kind of left me once it got cold. But I'm Dwaynia, and I'm the founder of Canadian Small Business Women, and I love to do things like these where you can get a whole lot of information packed into 1 hour that you can use to apply to your business. And I am not an expert in anything but probably like chemistry, but I find the experts, and Shalini is an expert. You can trust me on that. So she is going to be the one sharing all her wisdom with you today, because I know we always want to know more about taxes and what we are doing wrong and how to do things right. So I'm going to share, Shalini, if you have any like questions you want to throw out there for people to think about while I try to set up this feed.
So do you want me to do the screen share for the PowerPoint, or are you going to do it?
I will do it once I get this set up, because
I have the option to do it myself.
Watch you speak and also see your presentation.
Okay, no problem. Yeah, because I can share as well, but I just wasn't sure last time you were doing the next for me. So
Yeah, no, I got it. Don't worry. Nobody wants to have to see me. I'm gorgeous, I know, guys, but you don't want to have to see me while Shalini speaks.
So for those of you that are in the chat, feel free to post your questions there. While we do kind of have a little bit of a set agenda, I will keep checking in on the chat, at least in Zoom. Facebook, unfortunately, won't be live on my screen.
I will field the Facebook questions for you. I will definitely ask.
And if you hear screaming in the background, that's just my husband trying to deal with our 2 kids. So ignore that.
They'll still be alive. That's all that matters at the end.
I don't know. Husbands don't deal with the kids as much, and he has to put them to bed soon. So,
okay, we shall pray for them. Why is this spinning like nobody's business and not? You know what? It's okay. I'll see if it will work, and if not, it's fine. I'll just share the actual. I'll just share the actual chat once it's done in Facebook. So what I'm going to do is share my screen, guys, so that Shalini can wow you.
And Peta, I see your question, and I will be answering that in the presentation, so don't worry.
All right, so share. And I need to run this. Perfect.
Okay, if you want to go into the, there you go. So, hi everybody, my name is Shalini Darna and I'm a chartered professional accountant. And just a little bit about me, I went to U of T, did a specialist in accounting, and a lot of my work experience is with Ernst & Young, BDO, which are large accounting firms. And what I was doing there was actually helping large companies make sure their accounting and tax foundation was set up properly and that their financial statements were accurate to make informed decisions with them. And now I do that on the sole proprietor or small business level. I also work with my dad, so I'm actually taking over the family business. He's also an accountant. Actually, he has the entire alphabet behind his name, as you can see there. And what we do that's very special is that my dad is also a financial planner. So our unique proposition, if you will, is that it's not just about paying less taxes, it's about your overall wealth, your overall portfolio. So I do a lot of financial planning and financial literacy education as well, helping entrepreneurs understand their numbers, because without that, you're never gonna have your business grow and succeed, because there's only so much we can do with taxes. But there's still a lot we can do with taxes. And so do any of you wanna get into the next slide, please? So key dates. For a sole proprietor, or for everybody in general, the tax deadline is April 30th. If you're employed, you get your T4s, you file your RSPs, donations, all that fun stuff. If you are self-employed in a sole proprietor setup, and what that means, as a sole proprietor, the business is actually under your legal name. It's not a separate entity. And so because it's in your legal name, you actually file all of your business related items, your income, your expenses, as part of your personal tax return. And you actually have until June 15th, although this year it's June 17th because the 15th is a Saturday, you have until June 15th to file as a sole proprietor. The catch to this is that if you have any taxes owing, a tax liability, you actually have to still make that payment in full by April 30th to avoid the tax any interest or penalties on that. So the tax deadline, in my opinion, even if you're self-employed as a sole proprietor, is to just file it by April 30th. Now the difference, if you were incorporated, is that you actually get to your end to file a corporate tax return. So corporation is a separate legal entity in itself, and the operations of that legal entity are not combined with your personal income on your personal tax return. So the April 30th deadline, if you are just working somewhere, you'll get your T4s hopefully in the mail sometime in February or early March, and any other slips you have. Sole proprietor, again, you should be doing your bookkeeping now, getting all those numbers organized by the different categories, which I will show you guys in a little bit. And those get combined into one tax return. And so March 1st is the deadline for RRSP contributions. And RRSP contributions are one way that we can help reduce your taxable income. So in general, the way that the tax system works, you have your total income. This is all the money that you've earned worldwide. And whether that's your T4 income, if you get commissions, you'll get a T4A, dividends, investments. And in this same chunk includes all the revenue that you've earned as a business owner. That's your total income. Then we apply all the various deductions, RSPs, donations, medical, etc., that happened in 2018 to come to your taxable income. And then based on whatever marginal tax rate you become in, that's how much taxes you owe in the year. So 2018 is done. The only thing left to help reduce your total income is an RSP contribution. So that, like I said, the deadline is March 1st. And for those of you that do happen to owe any money, or if you believe you owe money, this year the CRA has decided to get with the 21st century, and they've created an app for that. So you can actually pay by apparently credit cards now as well for your tax liability. So I just wanted to mention that because a lot of people struggle with how do I pay my taxes. There's an app for that now. Next slide, please. So on the personal side, there's a couple of new things that have come into play that I just wanted to touch base on. One is the climate action incentive. I'm not going to get into the politics behind this, but basically on April 1st, there's going to be a new carbon tax or some sort of a tax on gas and natural gases. And what the government is doing for provinces that aren't regulating it, they're offering a tax rebate. It's only one person for every family living under the same roof should claim that credit. And I want to mention this just because it's new, and unfortunately a lot of tax preparers don't necessarily keep up to date with things. So just make sure that whoever's preparing your taxes, just mention, did you apply for the climate action incentive this year? Because it's actually going to be new to us as tax preparers as well. If you do happen to claim medical tax expenses and you happen to have a service animal, you can actually now write off a portion of the service animal cost as well. And the credit is only for animals trained to perform specific tasks that help their owners cope with their impairment. So again, if you know somebody that perhaps has a service animal and you know that they haven't had any tax benefits or tax expenses related to that, new for 2018's tax return, you can do that. The Canada Workers Benefit is also going to be new this year. And this is basically another credit to help low-income workers qualify for a bit more of a benefit. And it's to, as they say, intended to help the working poor stay employed. Another change, the basic personal amount for 2018 is $12,069. And all this means is that any income that you've earned under $12,000 is tax-free. So just a reminder that all your income and expenses need to be reported on your tax return in Canadian dollars. So if you have property in the States, rental properties, or investments that are paid to you in other countries, they still need to be reported on your Canadian tax returns. And in many cases, they need to be reported in those respective countries as well. For example, if you have a rental property in the States, you file a US tax return to report that income, as well as then we report it in Canadian, and we need to apply to make sure that you don't get double taxed. So just wanted to put that out there because a lot of people forget to report their foreign income. Now for the fun stuff, the business updates. So as self-employed people, we pay both the employer and employee portion of CPP in our tax returns. And so for 2019, this has gone up. And so for self-employed people, the max that you will end up paying in 2018 is $5,187 in CPP. And in 2019, that's going up to $5,497. So you don't have to worry. This is not a separate remittance that you need to make. It actually gets calculated in your tax return itself. And that, like I said, is the maximum. It's if you didn't make a profit or if your income earned warrants a lower contribution, the system will calculate that automatically. In 2019 or in 2018 as well, the small business rate, which is what the corporations are taxed at, decreased. And so for 2019, it's actually going down another percent to 9%. And this applies only to corporations only. So a lot of people are starting to ask me, should I incorporate my business? So I have a slide on that next, but it's a good question to start asking if your business is in the profitable or becoming profitable stage. The other thing is passive income changes. So last year, the government decided to change some of the rules within a corporation. So previously, a corporation could basically have investments in the corporation's name, and that was a really cool way for us to help our shareholders grow their portfolio, grow their wealth, without having to withdraw the money of the corporation. And so CRA, as they often do, caught on to that. And so now, when it comes to passive income, you're only allowed to have $50,000 in passive income to qualify for the small business rate. So that's that 9%. So again, if you are incorporated and you happen to have investments, make sure you have that conversation with your accountant and your financial advisor, if they're two different people, about what needs to be done to either change the way you're holding the investments or just be cognizant of the fact that there is a change happening. And basically what the government wants to do is get people to reinvest their passive earnings into the businesses, either by hiring more people or by investing in capital. They don't want people just to have huge investment portfolios sitting within the corporation. The other thing that also changed last year was the shareholders qualifying to get dividends as a shareholder. So one of the things, again, that we used to do for small businesses was have both the husband and a wife be the shareholders of the business. And because they were both the shareholders, they could actually both get a dividend. And this was a completely legal way of doing income splitting or income sprinkling, as they call it. And so now what they want is to show that the shareholders are involved, actively engaged in the business. So they don't want people becoming shareholders just to get the advantage of a dividend. So there's not necessarily a tax advantage anymore to have a spouse on as a shareholder if they're not actually involved in the business. Same with children. So again, if that conversation has not come up, please do have that conversation, because these are all new. The income splitting one actually just happened in 2018. So depending on what your year end was, that conversation needs to happen. So those have all been kind of negatives. What's a good thing that's happened in the corporation world? So we've got the lower interest rate and we've got the changes to the way that assets are depreciated. They've accelerated that a little bit for 2019 onwards. And that means you get to expense more of it in the year that you purchased it, and therefore reduce your profit and hopefully reduce the taxes owing. So I see there's a few questions here, so I just want to quickly scroll to make sure I answer them.
So there are 3 questions in the Q&A section, and then I wrote down 3 others. So in the Q&A section, Salima asked, is it better to file her child's tax return with hers, or can it be done separately?
A child's tax return?
How old is... Salima, if you could probably give a little bit more detail, like how old is this child?
Well, it doesn't really matter. So each person's tax return actually gets processed separately. So even if you're married, they get processed as 2 separate tax returns. When they're coming up with certain credits or benefits that are dependent on the household income, that's when they'll look at the tax returns combined. So technically your child's tax return is not usually included in that kind of framework of household income. So there really is no difference to doing it separately versus combined. If that child, however, is in university or college and eligible for what remains of the tuition or school credits, then it makes it easier to apply those credits to the parents. So either way, most people charge per person, so it's not going to necessarily be a cost advantage. And if you're just going to one person, then they already have all that family history. They can just attach it to your return, and it's a little bit less administrative work, but it doesn't necessarily have an advantage tax-wise one way or the other.
Okay, so the other question, if you are a new business owner, at what point does the government expect a business to show income or profits?
Unfortunately, there's no magic number for that. If you really want a number, I'll make one up. But for the most part, there's a reasonable expectation of profit. Whether reasonable is 2, 3, 4, 5 years there's no magic number. But what they do look at is the overall trends. So, if year 1, you were really in the hole, year 2, you got a little bit better, 3, even a little bit better, and you're kind of inching towards that break-even part, then it can be prolonged. But for example, if by year 5, you're still really in the hole, that could be a red flag for them to investigate the types of expenses that you're putting through, just to make sure that you're not trying to cushion the expenses. But overall, from a professional perspective, if by year 5 you're still not making a profit and it's a legitimate, you're not kind of fluffing and inflating those expenses, you yourself probably need to start evaluating whether or not the business is viable or not.
I guess this one varies, but she's asking how much you charge to complete tax returns.
It depends on the complexities. So my base rate for a corporate tax return is $1,000.
And there's another one. Is it convenient to have a CRA number if the company does not gain the minimum amount needed to declare taxes?
So there is no minimum amount needed to declare taxes. If you have a business, even if you earn just $1, you need to file a tax return. The benefit of filing a tax return, even if you are in a loss, is that those losses get recorded, and eventually when you have a profit, we will apply those losses to the profit to help reduce the taxes owing. So and this applies whether you're incorporated or a sole proprietor, you want to always file the taxes whether it's a loss or not. For the not part, like I said, even if you just earn $1, there is no minimum that you need to earn before you file a tax return.
Okay, one last question before we keep going. Francine asked, how do you pay your CPP, and do they tell you how much, or is it just added to your taxes?
It's just added to your taxes. So as part of that tax bill that you owe them, it'll get calculated within the system and be part of your taxes owing portion. But there is a separate schedule. So if you're curious how much you are paying in CPP, the accountant can tell you by reviewing that part of the schedule with you. But it's not a separate payment. It's all part of that taxes owing part.
Salima wanted to be clear at how much is it for a non-corporate tax return?
Salima, why don't you message me, because that's even more complicated depending on what else we're dealing with. So at the end of this, I didn't put it in the presentation, but I'm going to have Dwaynia send out a Calendly link so that everybody who attends the webinar gets a free 30-minute consultation with me, not to interview me, but to ask your questions and to any clarifications on what I've spoken about. So Salima, if you do then book a consult, we can just then have that, we can talk about that at the same time.
Okay. We'll answer questions later on again. So let's keep going.
So let's keep going. So the question then becomes, so like I mentioned, because of the low interest rate that corporations now have, a lot of people ask me, should I incorporate my business? And this is a fabulous question to talk about at tax time. So as I mentioned, a corporation is a separate legal entity. So just like when you have a baby, you get a birth certificate. When you create a corporation, you get articles of incorporation. And this means that the business, the incorporated business, can enter into legally binding agreements as if it were a real person. And you, the owner, become a shareholder of that business and are basically responsible to make decisions on behalf of the business, and keeping in mind that those decisions have to be in the best interest of the business. But a lot of people think that there's some sort of a magical number that when you make, $43,222, that's when you should incorporate. And the reality is that's not accurate. In fact, whether you should incorporate really has nothing to do with your revenues, your expenses. It's often more situational based. So there are 4 main criteria that we look at, or that I look at when having that conversation. First and foremost is a legal consideration. As a separate legal entity, the assets and the liabilities of the business become separate from you, the personal. So your personal house, your personal car, they're no longer on the line for the operations of the business. So a lot of people that are especially in maybe high risk areas, they like to have that legal separation, that these are my business assets, this is my business operations, and this is my personal assets, and the two are not mushed. The only caveat I'm going to put to that is that if you do happen to get a loan, they may ask you to personally guarantee it, in which case your personal assets are still on the line. But by and large, for example, let's say something happened and you got sued. The claim of that would only be to the extent of what the corporation has. So that is a bit more of a lawyer speak, but that is one reason why a lot of people like to incorporate from the get-go, is for that legal separation and the limitation of liabilities. The second thing we need to look at is, are you going to withdraw all of your profits? What happens in the corporation is the corporation has all the revenue, has all the expenses, and at the end of the day, you, the owner, need to pay yourself somehow. There's 3 ways that we pay you. One is by salary. So you take out a salary, you get a paycheck just like any other employee. The second is via something called a dividend, which is only eligible to shareholders, so the owners of the business. And the third is a reimbursement of money lent to the business. So if you're going to take everything out of the business, then then the tax benefits are not going to be there. You need to go.
I want to ask you something.
You need to
Hi.
go. So, please.
No.
Okay. So what happens is the corporation is going to pay its taxes, and then when you take it into yours, whether it's salary or dividends, it's going to get taxed on your personal income. And so if you're going to take out everything, that tax advantage aspect gets lost. So that's another thing to consider, is can you actually leave money in the corporation, yes or no? Sorry. The other one came in now. The third thing is the administrative responsibilities. The legal and accounting costs are higher when you incorporate your business. And so you need to factor that in. A corporate tax return is more complicated. The bookkeeping is more complicated. And so if any of that costs are not sustainable, if you can't manage them, then that could be a reason not to incorporate yet. And the last thing is financing. Believe it or not, in the eyes of creditors, a corporation is a bit more legitimate, and it's a little bit easier to get financing as a corporation than as a sole proprietor. So those are the 4 things that we need to take a look at and see whether or not it makes sense for you to incorporate your business or not. The tax benefits are just one aspect of it. And so another reason to incorporate is that we can actually manipulate how much money you take out into your personal tax returns. I mentioned there's 3 different ways that we can do that. So, for example, if you are, please turn on the light. If you are a, hold on, just 1 second. Chris, can you just come take them?
Sorry.
Sorry about that, everybody.
It's okay. That's like the mom entrepreneur lifestyle.
Like that guy who was on CNN and then the kid came in and the wife had to grab the kids out. Sorry. So what I was saying, so we need to have a conversation about what your needs are, because, for example, we can manipulate so you don't have as much income showing on your personal tax returns, and this could increase your childcare benefits. But if your mortgage is up for renewal, then you may want to show more salary versus dividends so that the mortgage financiers don't question your eligibility to see a mortgage. The worst thing is when an entrepreneur is trying to get like $1 million house, but they're only showing $20,000 worth of income. So these are all conversations that need to be had to answer the question, should I incorporate my business? And again, I apologize for that chaos.
It's okay. Pizza Gay wants to know if she has to incorporate her business in order to lease a car in her company's name.
So technically, yes, because as I mentioned, as a sole proprietor, you are the legal entity. So the company, like the leasers, probably would not put any other name on the lease agreements because legally it is you. So when you incorporate, because it's a legal entity, that corporation can lease a car. The only caveat that I'm going to point out here is that if you are going to use that car for personal purposes, then I would not put it in the company's name, because any personal use of a company's vehicle gets added in as a taxable benefit. So just a little caveat to that over there.
Okay.
So the fun stuff. This is a list predominantly for the sole proprietor of all the things that you can expense. And when I say predominantly for the sole proprietor, this is actually verbatim from the Schedule 2125 in the sole proprietor schedules. As a corporation, the categories are a little bit different, and actually there's more detail required. But by and large, these are the main categories, whether you're self-employed as a sole proprietor or a shareholder, that you can write off. And the ones that I've highlighted in red there are not only the most common, but also some of them are also the most audited. So whenever you have an expense, people ask me, what can I write off? The general rule is any reasonable expense that you incur to earn income is an eligible expense. So I'm going to say that again. Any reasonable expense you incur to earn income is a allowable expense. So that's a pretty wide array of, what's reasonable, how do I earn income? So my general rule of thought when you're trying to figure out if you should write something off is assume you had an employee and the employee wanted you to reimburse them for that expense. If you would not reimburse an employee for that expense, then odds are you as the business owner should also not write off that expense. Because if the employee needed to expense that to earn income or bring in a client, do the work, then it would be reimbursed by the business owners. As a general rule, always get receipts or vouchers when you buy something for your business. Credit card statements and bank statements are not allowable support for the CRA should you ever get audited. And a lot of what we talk about is just in that worst case scenario if you ever got audited. You don't submit your receipts with your tax return, but you are required to keep them for 6 years. And make sure the receipt has all of the following information: the date of the purchase, the name and address of the seller or the supplier, a description of what it is, and if they are registered for HST and charging you HST, they actually need to have the HST number visible on the invoice or receipt as well.
What do we do in instances where receipts seem to fade nowadays after like a year?
Unfortunately, if let's say you did get audited and the receipt had faded and you cannot support the amount, they could deny the expense because the receipt has faded, even though it's no fault of your own. So I do recommend, in this day and age, we've got lots of different apps out there where you can take a picture of the receipt, and therefore you know that the quality of the receipt is going to maintain itself over X number of years. The caveat to that being, if you say my hard drive crashed or whatever, and I lost all my receipts, so you need to make sure you kind of have backups of your backups of your backups. I personally use HubDoc to take pictures and forward my information to. QuickBooks for self-employed has apps. There's Receipt Bank. Or you can even just good old-fashioned get a scanner or take a picture and save it to your Dropbox, whatever works for you. But yeah, if your receipt fades and you no longer can see the information, they could deny the expense, even though you have the receipt. They just don't know what it's for.
I feel like the one that's very popular for that is gas receipts. They fade quickly.
Yeah, and unfortunately, that's just a risk that we take as business owners. But I mean, when it comes to the gas receipts, they're small amounts, and as long as they can kind of see the name, and if you did happen to do it on your credit card, for example, and you have that statement, they can kind of cross-reference it. So gas is a little bit easier to have a workaround, if you will, but it's those really large ticket items that are adding to your expense. You really want to make sure that you maintain good copies of anything that's really expensive.
We'll answer some more questions in about 10 minutes, guys.
So I just want to quickly go over some of the high risk expenses. So meals and entertainment is probably the most audited CRA expense out there. And so for tax purposes only, 50% of meals and entertainment is allowed as a write-off. And so a common mistake that I've seen people make is they themselves will take off 50% when they're doing their own bookkeeping. But then when they give it to me, it's already 50%ed. But when I put it into the tax system is going to take an extra 50% off. So you, as the business owner, record 100%. Just know that when it goes into the tax system, it's going to get 50%ed. And again, with meals and entertainment, make sure you keep the itemized receipt that shows what you purchased. And be careful of having too many meals and entertainment with people that aren't clients or referral partners. A lot of people, when they're networking, they do meet for coffees, and those are relatively low expenses. So keep the higher, more expensive lunches and dinners for clients and true income earning clients or customers. And the casual networking, keep that to more like coffees. You just don't want to have meals and entertainment as your biggest expense that's in your business. And that's just kind of good business practice anyways. The second most audited expense is business use of home. And the criteria to be eligible for business use of home is one of two things. It's either your principal place of business, or you use it often and on a regular basis to see customers, clients, or patients. So for a lot of people that have home-based businesses, but they're always going out to meet clients, automatically number two goes out the window. And if you happen to rent an office space or you have an online shop, it may not be considered your principal place of business either. So whether it's worth it or not to write off home office is another question to have when you're filing your taxes. The way it works is we take a percentage. So it's usually the percentage of your room divided by the percentage of your entire house. And then all of your home-related expenses, your utilities, property taxes, mortgage interest, et cetera, all of those get that percentage applied to it. So at the end of the day, for most of my clients, I find it's not a huge amount. And if they really can't justify why they need a home office, it's almost a negligible impact on their tax return. The next highly audited account is business use of car. So again, this is driving to and from clients or customers, prospective clients and customers, networking events. So you need to maintain a log. There's two ways of writing off business use of vehicle expenses. One is you add up all the gas receipts, all the repairs and maintenance, all of the car-related items. You take your odometer reading on January 1st and December 31st, and then every time you travel for business purposes, you track that kilometer as well. And again, we take a percentage, your business kilometers divided by the total kilometers driven, multiplied by all of that gas, repairs and maintenance, parking, blah, blah, blah. Sorry, not parking. Parking is 100%. But all of the other car-related expenses. And that becomes your business use of vehicle expense. The other option that you have is what's called the prescribed rate. So every year, CRA comes up with a per kilometer charge. That this is what companies can reimburse their employees for driving for business purposes without it being a taxable benefit. We apply that same logic to you, the business owner, that we can reimburse you X amount and call it a business a kilometer expense. So if you drove 5,000 kilometers, you would take, so for 2018, the first 5,000 kilometers, I believe, are 55 cents, and every kilometer thereafter is 49 cents. Don't quote me on that because every year it changes. So we apply that per kilometer charge to your kilometers, and that is actually a bit more of an efficient way. You don't then have to add up all of those gas receipts. You still need to keep them. They help support the fact that you drove your car as much as you have, but it eliminates the need to do the bookkeeping for them, helps that receipt fading issue a little bit as well, because we say we didn't add up the gas receipts. We actually just took our log and multiplied it by the CRA prescribed rate. And those are probably the three most, and then the fourth most audited is advertising and promotion. And again, as long as it's for promoting your business, it's a legitimate expense. So whether it's paid ads, business cards, vendor tables, donations, gifts, all of that are legitimate. Just be careful about excessive gifting. So if you went out and bought, $1,000 worth of gift cards, be able to also support that with a list of clients that you sent those gift cards to. Because sometimes they can ask, okay, who did you actually send these gift cards to? And if you don't have that list to be able to support that expense, then that's a huge red flag. So this is a good point to stop to see if there's any questions on expenses. And I see a bunch on the feed.
Yeah, there's a lot on the QA. So Colette, do I have to have an HST number if I earn less than $30,000?
So 30,000 is the magic number where you are legally required to start charging HST on your services or your products. But if you happen to be in an industry, if you happen to have a business that is incurring a lot of expenses, and those expenses are being charged HST, you cannot claim what they call input tax credits unless you registered for HST. So what happens is when you've registered for HST, all of the HST that you've collected gets offset by all of the HST that you have paid on your purchases. So for example, if you collected $100 in HST on your services, but you actually paid $125 on your expenses, you would get a $25 refund. So you do not get the benefit of that input tax credit without that HST number. So I always tell my clients to just start charging HST from day one. It gets your customers and clients used to the concept of paying HST. They get charged on HST on everything else anyways. And then you get the benefit of being able to get a little bit back on your expenses as well.
Okay. Maria asked, if I have an online store, it's a business incorporated in Canada, and someone is purchasing an item from outside Canada, should she charge tax? Which one?
So the general rule of thumb is that you charge tax based on the location of where the service or product is being sent to. So if you did work in California and the product was being shipped there, you would then charge their respective tax on it. But it also varies depending on the type of business and the products. But most of the online platforms, once you say that you're selling it internationally, will set up all the taxes appropriately. But for example, if I ship something to Alberta, I have to charge them the Alberta taxes. But if I'm doing consulting and I'm doing the consulting work from Ontario, then I would charge the Ontario tax. Or if I have a client from the States that comes to me for consulting and I'm doing the work in Ontario, I actually don't charge the US clients anything. So that's where I say it's not an easy question to answer in this forum. More information is required. So you could possibly have to charge taxes.
Where can we find the allowable business expenses for incorporated businesses? Dashahi asked that one.
So if you go onto the CRA website, somewhere in there, look for something called the GIFI, General Index, GIFI. That is a list of all of the, lack of a better word, the chart of accounts, all of the codes that are eligible in a corporate tax return. And just make sure that you set up your chart of accounts to mimic what's allowed as part of the GIFI listing. It's about 4 or 5 pages worth. Or if you have access to T2, you can take a look and see what is written there. But I don't think they have a listing like they do for sole proprietors. But like I said, majority of the expenses follow under very similar categories. It's just there might be a subcategory or a different terminology.
Okay. Can you scan this receipts for safekeeping? You've already answered that. Does it have to be the original receipt? You've already answered that.
A photo is considered an original receipt, so you don't have to worry. You can destroy the receipt after you've scanned it.
Okay. If you bartered some services, is it recommended that you report a dollar amount as part of the income for the year or not?
Yeah, so barter transactions are still work done. So the way that the system works is that revenue is reported when the work is done, irrespective of whether cash has been exchanged. So you have to figure out what that barter was worth and record that as revenue. And hopefully, if the exchange of service was of equal value, at the end of the day, your net income is going to be zero. So I always say, issue an invoice, exchange the cash. One, it gets you into the habit of doing that. And heaven forbid down the road, they don't need your services or vice versa, but you still need theirs. Well, you've already built it into your system of getting invoices and making those payments and having the cash flow for it. But yes, bartering transactions do need to be reported.
Would continuing education or skills upgrading related to business be considered an allowable expense?
100%.
Yes, perfect. Just to clarify, you still need to keep a mileage log if you're using the prescribed method to calculate vehicle expenses.
Yes, so you need it, regardless of which method you use, you do need to maintain a log. And that log should basically say the starting point, the ending point, and the business purpose. So why did you have to go to wherever, and the date. So there's different apps that people use to track miles. There's like Mile IQ is one of the most popular ones. I personally use Google Maps. I just sit on my computer, have some TV on, and put it into Google Maps to figure out the kilometers driven, whatever works for you.
She wants to know also, is it logged daily or monthly?
It is as you drive for business purposes.
If you have 2 or more different sole proprietor type businesses, like i.e. a yoga instructor and a dog walker, do you file 2 separate T2125s? Also, do you pick one for the vehicle expense as opposed to tracking by business type?
So each business that you register with CRA needs to have a separate Schedule 2125 completed. And when they're really different businesses, then we do suggest that you do file them as separate tax returns. Just keep in mind, if you're going to register them as 2 separate businesses and have 2 2125s, you're also probably going to get charged for 2 business returns because we have to fill out all the schedules. So depending on the dollar value, sometimes we just recommend combining it and just doing 1 business return, but keeping 2 separate financial records so that if CRA ever came and audited, we could say these are actually 2 businesses. But CRA would always say yes because they want to track each industry, so they need that information separated.
Angela is asking, what are bad debts? Because you have allowable business expenses and bad debts is the 3rd one.
So sometimes as business owners, you do work and you give people credit and they don't pay you. It sucks and it happens. But when that happens, you don't go back and delete the invoice. You actually write it off as a bad debt, especially if it happens after your fiscal year. So for example, let's say I did some work in December and the person was supposed to pay me, 30 days on demand. So in December, it went in as revenue. But in January, when I realized that they're not going to pay me, I can't go back and undo my financial records for 2018. I'm going to write it off as a bad debt in 2019.
So in that case, I'm just trying to see, let's say for my example is I have vendor events and then vendors fill out the form and express interest and I send them an invoice and then they change their mind. There was no work done on my part. Should I not cancel that invoice?
So what I would actually do, so an invoice is when work is done. And so until you've actually had the event, it's not technically an invoice. So for lack of a better word, it's like a purchase order.
Yeah.
Purchase orders can be canceled. That's no problem. But if you did the work with the expectation that they're going to pay you later, so I do somebody's taxes, and I give people payment plans. So, a lot of the time if I'm doing an entire year's worth of work up front, they can't pay it, so I give them payment plans. And it's happened to me where people have just not paid, and so I have to write them off as a bad debt.
Okay. One more question and then we're going to continue. I have an office in my home, but I do not meet clients there. I do a lot of work though. I've been claiming it, but maybe I should not. Thoughts?
So just because you need a place to work does not always, in the eyes of CRA, justify a home office. Think of all the people that work in a corporate world and they take work home with them. So just because you have a den doesn't mean that it's okay to claim home office. But the flip side, if that's your principal place, if that is like on your business cards, if you are actually producing a product versus just doing administrative work, so you're doing the client work or you're creating the product, then we can justify it. It becomes more of an issue for people, like I said, that have online stores, especially people in direct sales. I see this a lot where they're not doing any work in their office. The customers are purchasing off their website. They're meeting people out for coffees. So really their home office is just more for the administrative aspects. Them I caution, you know what, maybe we don't. And then I show them the numbers to say how much of an impact they're really having. But should you or shouldn't you? It's also a risk factor. So if you are comfortable to say that I need my home office to do the work, and you don't have any other office space to be able to do it, then 100% claim it. So it's not a black and white answer. It's a conversation to be had.
Okay, so we're going to push on with the presentation and then we'll answer some more questions.
Perfect.
We're running a little low on time. Okay.
So a lot of people ask me, like, how do I know I'm going to get chosen by CRA for an audit? And there's a number of reasons why you're get chosen. So one is just a concept of random selection, where they're just comparing your information, or you just get chosen, or they compare your information to third-party information. So if you say you're living in the most expensive area of the GTA, but your tax return is only showing you're earning $30,000, well, that's going to be a red flag of how are you affording to live there. The types of deductions or credits that you claim can also be red flags. So we've already talked about, you know, business use of home, meals and entertainment, business use of vehicles. Those are your three main and the biggest expenses. That's a red flag. And then certain industries that are just riskier, like cash-based industries, they get chosen a lot for audits as well. But a red flag doesn't mean that you're going to get audited. It's just a red flag. So just to note that if you've received your notice of assessment, it doesn't mean that your taxes are done and you're good. They have 6 years to audit you. And sometimes they will come to your place of business and want to see the information. Sometimes they'll tell you to scan it and send it to them, and it's called kind of a desk audit. And so they will, like I said, ask for usually the original itemized receipt. And typically, or in very rare circumstances, do they accept credit card or bank statements as proof. Next slide, please. So as I mentioned, these are some of the red flags. So they'll look at revenue discrepancies. So when you do, for example, file your HST return, if your HST return shows 30,000 in sales, but your tax return is showing 10,000, then there's a discrepancy there. Or if you had to file some other tax paperwork to maybe get some credits, and they don't reconcile, those can be red flags. I already mentioned being an outlier. So if you're living in an area but not earning enough to support living in that area, that's an outlier. We've talked about the large business expenses, and as I mentioned, those are the three, or those are some of the most common ones. And so there's miscellaneous. Really, after all the categories of expenses, you should not have anything under miscellaneous or other. If you do, we need to have a conversation. Business use of home, vehicle, large changes in balances, especially if they're payables or receivables, that can cause a red flag as well to understand what's happened in the business. Cash intensive businesses, recurring losses are a red flag. So somebody had asked that question earlier, and while there's no magic number, 3, 4, 5 years of recurring losses can be a red flag. Large charitable donations can also be, especially if they're causing a significant reduction in your income. And last but not least, family on payroll. That's a huge red flag, and they're really coming down on this. As well, I didn't actually put it on here, contractor versus salaried employees. If you show people as independent contractor and they should be on payroll, that can also be a red flag. And once you stay on their radar, you're kind of on it. So these are just some common mistakes. We've talked a lot about some of these, but in general, outside of even taxes, these are some things that you should start thinking about. For example, updating your will. You'd be amazed how many business owners don't update their will for all of these new assets that they now have as a business owner, and that can cause problems should something ever happen to you. Estate planning should not happen when you're 60 looking to retire. It should actually be once your business is somewhat established or stable, and especially if you do have other family that you perhaps want to bring into it or pass it down to. Do not wait to think about your estate planning until when you want to retire. We talked a little bit about voluntarily charging for HST if it warrants it, not incorporating at the right time, not tracking interest on loans into the business or on investments. And this is a huge one. I find a lot of people are willing to have personal debt and they use their savings for their business. But if the interest cannot be tracked to the business, we can't write it off. So what you should do is flip that switch and put your business on the credit cards and use your savings to fund your personal life, because then the interest on that loan into the business, it becomes a write-off. And the last slide is just a little bit of self-promo. I do have a workshop coming up on February 26th. It's during the daytime. And we go over every single category of expense in detail. It's about a 3-hour workshop. And we calculate, walk you through the calculations, the HST, pros and cons. You get a Excel workbook to do your own bookkeeping. So as a thank you for watching me here for the last hour talk about taxes, which I know is everyone's favorite topic. If you use that code, you get 10% off. And I will also ask Dwaynia to send out a Calendly link so that you can book a 30-minute consult with me to answer.
I will send out a copy of this final slide along with anything else you want me to send out. I will send that out either late tonight or tomorrow evening, because I'm going to upload this webinar tonight to YouTube. And I will definitely send everything out to everyone who registered. So some of the people who didn't even get to attend, they will also get this information. We do still have more questions. You are the popular lady for Q&A. So Patricia's asking, she just wanted to clear up about the last question that she asked about having 2 unrelated businesses, both T2125s would be under her own name, not registered with CRA.
So you should register with the CRA and get a business number. And like I said, depending on I think you said you had a yoga practice and dog walking, was it? Yeah. Depending on the revenue amounts, it might be okay to just put them under one because it's not revenue intensive. But you should register it and get a CRA number. But you can still register that CRA number in your personal name. You don't have to have a separate name.
What are some mistakes that you've seen most business owners make or forget to claim?
Well, first of all, they don't use me as their accountant, so that's a huge mistake. I'd say the number one that I just kind of mentioned briefly was the interest component. A lot of people, like I said, have this idea that they don't want their business to have debts. And so they put all their savings and personal income into the business, but then their personal life, they're running that off of credit cards or lines of credits. So if you just flip that, then we can actually write off the interest. And from a cash flow perspective, it's not any different. The other most common one, not charging HST, but having a lot of expenses, especially in the first year or so when you're maybe doing a website, doing a lot of consulting, buying a lot of supplies and whatnot, all of that's being charged HST. That's a missed opportunity, and we can't retroactively go back and claim it. That's probably the 2 biggest ones that I can think of off the top of my head.
Okay, so Heather's asking, for a law firm, does she need to count, does she need to count file disbursements as revenue?
So law firms have an entire set of rules that they need to follow to be complying with the Law Society of Ontario. And so off the top of my head, I don't know what you mean by a file disbursement, but basically any legal fees that you charge for your services is always revenue. But I would need a little bit more clarification of what you mean by a file disbursement, Heather. So if you want to message me, we can have that conversation.
Pizza Gay is asking, should she incorporate her business now or after April 30th?
It doesn't really matter. You may want to wait until your tax return is done, and then, like I said, have that conversation as to whether or not it makes sense to incorporate your business. But whether you do it now or 3 months from now doesn't make a difference. Your year end is any 365-day period. I always advise my clients not to do December 31st as their year end. People love having a year end that's a calendar year end. But what happens is you have to file your all your T-slips by February 28th. So that if you have a December 31st year end, we then are really in a crunch time to get the bookkeeping done and to have a decision as to whether you should give yourself a dividend or a salary, because each of those requires a T-slip that needs to be filed. So summer tends to be actually the best year end for corporations, because that then gives us almost 6-7 months to have a conversation and plan. But do it now. There's no real difference.
Government schedule. Their year end is what, the end of May? Then they usually put out their new budget by April.
Yeah.
Follow their schedule. Oh, wow. This has been amazing. I think this is probably the record for the most questions in the Q&A section for any webinar.
I hope that doesn't mean that I wasn't explaining myself well.
No, it means that a lot of people this is probably one of the topics that people are most confused about. And they want to get it right because nobody wants CRA knocking on their door, right? So that is why, because everybody wants to know. And I love Shalini. Shalini is my accountant. So I love her. She keeps me on my toes. And FYI, Shalini, I have a surprise for you this year. I know I probably said this last year, but you wait. I will be on time. So I think she is a wealth of knowledge. Where is Shalini located? Shalini can be everywhere you need her to be.
So I do offer virtual tax filing. So I have clients all over Ontario. I don't typically take clients outside of Ontario. It just becomes a little complicated with each provincial taxes, but I do virtual filing. So you scan me and send me the information. I scan it to you back. You sign it, e-transfers, we're done. So location is not an issue. Even for bookkeeping, we can do remote bookkeeping, not a problem.
See, told you I'd find you the best. Did that. So again, if you have any questions, what I'm going to do is I will send out an email with Shalini's contact info. Shalini, please send me anything else you would like me to send out. I will make sure that's emailed out tonight or tomorrow. But this chat will be available online give me about half an hour, and it will be up on our YouTube channel. I will also share it on our Canadian Small Business Women group page, because I didn't get to do the live because it just didn't work this time. And yeah, I am very excited. Thank you all for spending your cold Wednesday night with us. What better way to spend a cold Wednesday than to learn how to better be business owners? Seriously.
Thank you all for joining and for participating. I really love it when I get questions.
Yes, yes. Everyone is singing your praises and saying thank you. Thank you all, seriously. And thank you, Shalini, for being such a wealth of knowledge. And I feel like I always say this because it's the truth. Every time I just wrote down some stuff I need to go and look into, because, it's as if I've never heard you tell me all these things before. I still write it down and I'm going to look into it again, trying to be a better business owner and trying to learn all the things that I should make sure I know. Yeah.
And a big part of it is also ask your accountant. Like it's easy for me to say things, but we need to learn and look at your numbers when making some of these decisions. So you should be comfortable enough or feel confident enough to ask your accountant who's doing your taxes some of the questions as well.
Yeah. And for financial statements, for business financial statements, you do those separately as well?
Yes. So I do notice to readers.
Okay.
If those are all obviously only really applicable to incorporated businesses, but because not all entrepreneurs want them, that is a separate service that I offer.
Okay, that's good to know. All right, so I think I have taken up enough of your time, and thank you so much again for doing this.
Oh, my pleasure. And I apologize for that disturbance that happened in the middle.
No, that's life, okay? And hey, we all want to see the babies, so it's okay.
Well, you didn't see the little one. He was trying to climb up on the chair. He was too short to stand up. I've got a 4-year-old and a 1-year-old, for those of you that were wondering who those little people were that were around me. So
It's okay. They were wonderful.
thanks so much.
All right, have a great night, everyone, and I will see you again we have 2 more webinars coming up in March, so stay tuned for that. Have a good night.
Thank you.
Bye.